Hello and welcome to the Mutual Fund Show. My name is Niraj Shah, and over the next 20 minutes or 25 minutes, we will talk to a guest who's come often on the show, Vijai Mantri, to talk about a particular aspect of mutual fund investing. Now, viewers, all of you would have probably heard, probably felt as well that maybe, just maybe in these uncertain times, it is better not to have exposure to mutual funds, gilt funds, etc., and have safety in certainty, which is have safety in fixed deposits. The question is there a better way to earn fixed returns than fixed deposits, and can mutual funds do the trick? And is there historical or empirical evidence to suggest the same? Vijay, I think, has done some homework, and he joins us right now to talk about that. Vijay, good having you. Thanks so much for joining in. Let's classify this, Vijay. Let's assume that my viewer today is somebody who is happy with not necessarily inflation beating returns, but some certainty. And within that parlance, if he gets or she gets higher returns, then she or he is happy. Do we have a solution for that, which is non-FT?
Yeah, that's very true. And before I start, I would like to pause, and I would request the audience to, even after the show, just pause and think about what will happen to the retirement goal or any goal they have if the interest rate continue to remain low or start falling in India. If the interest rate goes to 4%, FD interest rate goes to 3%, 2%, then what does happen to their retirement goal? Do they have a solution to achieve their retirement goal? That is the one question. The second question, which is equally very important, is that any business can be funded through basically two routes. One is equity capital, which is riskier. Second is debt capital. But when you invest in India in fixed deposit, you don't get the return of the debt market. And I'll explain you through some numbers. So yes, to answer your question is absolutely right. There are alternatives available which are better than fixed deposit and less riskier than fixed deposit, provided somebody have a vision of at least 3 to 5 years. Then definitely over this time period, we have solution which could do better than fixed deposit, and actually they are not riskier, because today we are talking about gilt fund. Gilt funds are the fund which invest in the government of India securities only. They do not take exposure to the corporate bond, whether the AAA or AA. They just invest into government of India securities only. So credit quality wise, they could be one notch above the fixed deposit, but gilt rates are derived from the market participant. So it is a market driven rate. So it tend to be generally far efficient than bank fixed deposits.
Okay, so Vijay, just to clarify this for our viewers, the gilt funds, and most people would know, but there might be people who don't know about this. So the gilt funds, you're saying, invest only in government securities, which means that them going bust or them not honoring the commitment is almost next to zero, the possibility, because they are quasi-sovereign.
But they are not quasi-sovereign, they are sovereign because they are investing only in the government of India securities. So it's the government securities. It could be central government securities. It could be state government securities. And if you look at the entire debt market, the most liquid asset category is the government of India bonds only, because not only the mutual fund industry buy these bonds, but even banks have to buy these bonds under SLR. Insurance companies need to buy these bonds to protect their investor from the long-term interest rate downward journey. Pension fund buy these bonds, FI buy these bonds. So there's a huge demand for these bonds on a regular basis. Even the various trusts buy these bonds. So credit quality wise, they are one step ahead of the fixed deposit, because when people go toward the fixed deposit, currently they are looking at maybe perhaps top-notch private bank or a public sector bank to put their money. But after some time, when the concern about the credit quality disappear, then people start chasing return. And that is journey people took typically to go into cooperative bank, because for them, they can't differentiate between PNB bank and perhaps PMC bank. So, but in gilt fund, you don't have those kind of challenges.
Okay, what are the current rates of a Gilt fund, an average Gilt fund versus an average FD, Vijay? Have you guys done some homework on that?
So we have done some number crunching. So I'm sharing. Perhaps you can share with your our viewers the screen we have. So what we have done here, Neeraj, is that we looked at last 1 year, 3 year, 5 years, 7 year, 10, 15, 20 years. And what we did here is that we looked at what was the FD rate 1 year back. So 1 year back, around the same time, the fixed deposit rate was 6.8%. So if somebody invested at that time, the 1 lakh rupees, the net of tax, the 1 lakh has become say 1 lakh 4,000. Similarly, we have looked at what was the FD rate 3 years back. Around the same time in 2017, it was 6.25% for 3 year FD. So we put that number. Then we looked at 5 years back, 2015, the 5 years FD was at 725. 7 years back in 2013, the FD rate was 8.75%. And even 10 year back, we looked at FD rate. We took 7.5% from 2000.
No, let's
Sorry.
show this. No, let's just show these numbers on the screen, Vijay. Just a second. I'll request my producer to take the share screen slide that I have, and let's just
Okay.
try and show these numbers so that viewers can understand. And
Sure,
then
sure.
continue. Continue, Vijay.
Okay. So the point I'm saying that we took actual SBI FD rate, which was there 1 year back, 3 year back, 5 year back, 7 years back, even 10 years back. So what was there in 2010? It was 7.5% for a 5 year period. Then we assume that after 5 year in 2015, again you took 5 year interest rate at that time, which was 7.25. We did similar thing for 15 year and 20 years. And what you see net of taxes, you could see the presentation, the value in FD after 1 year, 1 lakh has become 1 lakh 4,000. In 3 years, it is 1 lakh 13,000. In 5 year, it is 1 lakh 28,000. In a 10 year, it is 1 lakh 65,000. People can see the value over a various time period. But if you look at the Gilt Fund during the same time period, so if you look at data, and these Gilt Fund number are for the entire mutual fund industry. It is not that we have picked up some best performing fund or worst performing fund. These are written for all Gilt Fund which were managed by the mutual fund industry. So last 1 year return in Gilt Fund has been 9.96%. Last 3 year has been close to 8%. 5 year has been 9%. And keep in mind, these returns are compounding. So when we say 5 year, it is 9% compounding. If you look at 10 year, close to 10%, 15 year, sorry, 10 year close to 9%, and 20 year close to 9%. So if you see the return which could have been generated, the 1 lakh net of taxes, if you look at the various time period, the Gilt Fund has delivered anything between 40% to 120% more than the fixed deposit during the same time period. And you could look at any time period as long as your investing horizon is 3 to 5 year plus. Gilt Fund make tremendous sense compared to fixed deposit, and we can explain why it does it so.
Okay, yeah. So, okay, this is an experiment that I'm trying, but I'm just trying to pull up this screen, which is on my laptop, full screen, and just try and show if indeed we can put up this slide, which shows that 1 year FD rate was 6.8%, and the gilt rate was about 9.96%. Which I just very quickly, this 1 year, 3 year, 5 years, 7 years, and the 10-year periods that you're talking about, are these from a particular date?
See, these data have taken on 31st August 2020. So 1 year back is from it means 1st September 2019. 3 years back, 1st September 2017. 5 years back, 1st September 2015, so on and so forth.
Okay, let me just try and see if I can open the presentation on my laptop once, and then just try and do a screen share so that people can actually see what we are trying to say. Vijay, just while we are doing that, I'm just trying to understand from you that a quick point that you mentioned about why why did you use the term that the gilt funds are less risky than a fixed deposit?
Because see, as I told you, if it is a nationalized bank, then there's no problem on the fixed deposit. But the moment people see nationalized bank offering say 5%. Why people went for cooperative bank? Because they are offering 2% more than the nationalized bank. So the journey people when people start buying corporate FD or people start buying bank FD, we have seen they first look at the top ranking bank and then do FD there. But after some time they go on the slippery path of chasing return, and in that process they compromise on this concept. But suppose you're investing in Gilt Fund for like 10 years, 15 years, 20 years, and you see 8%, 9% return, absolutely there's no need for you to migrate to anything beyond these products as long as your investment horizon is 5 year plus. So I'm saying from that perspective is a much better things to do than investing in fixed deposit. Fixed deposit can be done if the time period is shorter, but we have seen in India people doing 3 to 5 year FD, but after the 3 to 5 years, the FD get uh, 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 mature and then it get reinvested again. So the FD holding period is not 3 to 5, it is optical illusion. The FD holding period actually 30, 30, 40, 40 years, because more fixed deposit are renewed than the new fixed deposits are being made. Now we can see the screen we can see on the screen as well, Niraj, so we can share these numbers. But this is about the various time period we have taken where the Gilt Fund, this is the screen, yes, this is the screen. Viewers can see we have put data here where we compare fixed deposit return. 1 year back, what was the fixed deposit rate? 3 years back, what was the fixed deposit rate? 10 years back, what was the fixed deposit rate? And what is the value if you invested 1 lakh rupees during these various time period, 1 year back, maybe 5 years back, maybe 10 years back, maybe 15 years back, and it shows the value. And the yellow column shows the Gilt Fund return during the same time period, and you see the value. And the blue column shows you the higher return generated by Gilt Fund as compared to bank deposit. And for the calculation purposes, I have taken 30% tax slab for fixed deposit, and for Gilt Fund, I have taken 20% plus indexation. So you could see very clearly the numbers are very, very visible. And these numbers for the Gilt Funds are for the entire mutual fund industry. So these are the average numbers. So in this, you have fund which charging 1.5% to 2% expenses. And you also have a constant maturity fund where expenses charges around 20 basis point only. So if you go for a constant maturity plan, I think the return could be much better than these numbers shows.
Vijay, what about this? I mean, I'm just trying to understand one that the yields and the 10-year GSEC numbers that we have they shown good returns across time frames and across years? I mean, what if somebody were to start this say in March 2005 or say April 2009 or January 2015? How would the returns fare then? Is there some historical or empirical evidence?
Good point, Niraj. I think I'll also explain the risk in Gilt Funds, so people should not go and buy them blindly. But why Gilt Funds are looking very good as on date? Because the GSEC yield, the government of securities yield has come down. So basically, it means that interest rate in the economy has come down. So if you're holding old GSEC paper, the valuation has gone up. So you are seeing good return in the Gilt Fund. So what would happen suppose interest rates start to rise? Which are the better option you have? So what we have done here is very interesting, and it is very important for viewers to look at this slide and understand what we're trying to communicate. First time ever in India, 10-year GSEC went below 8%. It was around end of 2001. So GSEC yield was 7.91. After 10 years, suppose somebody invested in December 2001 in a 10-year GSEC paper, you would have got 7.91% for next 10 years. But at the end of 10 years, the GSEC has moved up from 7.91 to 8.74%. So the column, the column which we're talking about, period and GSEC yield, it means these are the GSEC yield 10 years later. But what has happened during the same time period? The investor got 8% CAGR over a 10-year period. Then the second we looked at, say, November 2002, where the GSEC has gone below 7%, March 2003, where the GSEC yield has gone below 6%. But more interestingly, let's look at November 2003, where the GSEC yield has touched 5%, around 5%. We have seen 10-year GSEC in November 2000. This go back to November 2003. Now, if somebody invested at that time in November 2003 in GSEC paper, the person would have got 5.10% interest for next 10 years. But in GSEC fund, the return was 6.4% annualized. So 1.3% more than that. And 10 years later, the 10-year GSEC was 874. So even in the rising interest rate scenario, GSEC fund has done much better job. And we can see this number when the interest rate rose to 8.29% back again in August 2006, and 10-year return was 9%. Again in August 2008, 10-year GSEC was 927 and 10-year GSEC return was close to 8%. So whichever time period you look, whichever the interest side, you look at the interest rate cycle going up or going down, GSEC funds has consistently deliver very good return. And I'll just put some number to you, Niraj.
Vijay, just one quick question. Based on this slide as well, you've given us GSEC yields and what the returns were. How are the FD returns around this time?
So I'll talk about that. So FD rate was around the same number. So if in November 2003, where we looked at GSEC yield is close to 5%, FD rate was also close to 5%. So suppose you took a 10-year FD, you got 5.25% for next 10 year, but in 10-year GSEC you got 6.4% compounded. And I'll explain you why this magic happened. It is very important to know why this magic happened. So in GSEC, what has happened typically is that we come to this slide later, Niraj. So you and me can talk right now. So why this happened?
Yeah, just continue, Vijay, no problem.
So why this happened? So suppose let's look at November 2000. Before that, let me explain you. If you're in 10% tax bracket, then on an average over a 10-year period, GSEC fund has delivered 30% more return to investor. Suppose you are in 20% tax bracket, then the GSEC fund has delivered 50% more than the fixed deposit. And suppose you are in 30% tax bracket, then the GSEC fund has delivered 80% more than the bank deposit over a 10-year period. But suppose you go to 20-year period, then this number becomes 50%, 80%, and 120%. And why this magic happened, let me explain you. Suppose you invested in 10-year GSEC and interest rate start to go up. So when interest rate start to go up, what you immediately see is a dip in the NAV of the fund. Basically, you will see some temporary losses in the portfolio. But this 10-year GSEC securities have a semi-annual coupon. So they get interest rate every 6 months. So when the interest rate start to rise, the coupon you get invested at the higher rate of interest. So for instance, in November 2003, suppose you invested in 10-year GSEC fund when the 10-year GSEC was 5.1%. Suppose 2 years down the line, the GSEC yield hardened up to 7% or 7.5%. So at that time, whatever coupon you got invested at 7.5% for next 8 years. We don't see that in FD. Suppose you invested in FD, even in compounded at 5%, it compounded 5% for 10 years. It doesn't take into consideration rise in the interest rate. And if the interest has to fall, then in Gilt Fund, you get capital gain. So in the rising interest rate scenario, in the falling interest rate scenario, if horizon is long enough, then absolutely Gilt Funds are no-brainer for investor to look at investing their money.
Vijay, I have a common man's question to you. How can this be possible that no matter what happens, I as an investor will benefit? The GSEC or the Gilt Funds surely should have some instance wherein they will not be able to give the adequate returns, right? It can't be that I'm buying at the particular point of time, which is today, and 10 years later, irrespective of whether interest rates rise or fall, I'll do better than FDs. Surely there has to be some chink in the armor, no?
Actually, there are no chink. The only chink is the volatility. Suppose interest rate goes up from here by 1% or 1.5%. Let's assume it goes up. Then you will immediately see 4-5% drop in the NAV of the fund. So perhaps you will not see return for 1 year. We have seen Gilt Fund not delivering return for 2 years. Even for 3 years, we have seen a low single-digit return in Gilt Fund. Only in 5-year period and above, Gilt Fund starts showing performance. So one is there is a temporary volatility. in the Gilt Fund. Second thing, what has happened? Suppose you are buying a 10-year GSEC paper. Suppose you're buying a 10-year GSEC paper in your private portfolio, or you're buying a 10-year GSEC fund. Suppose you're buying a 10-year GSEC fund in a private portfolio and interest rate goes up. You are actually not bothered about it because you know that whatever is the interest rate at which you bought the GSEC paper, you are going to get your interest every 6 months and you're going to get your principal back. Suppose you buy the same GSEC fund and interest rate goes up. Suppose currently it is around 6%, has become 7%. So what will happen? Immediately you will see some dip in your NAV immediately. But from that day onward, the accrual start happen at 7% instead of 6%. And all coupon re-get invested at 7%. So this is the magic, and many people don't even know because it is not been marketed to investor. And it is a very ironical, is very sad statement on all of us, including advisor and mutual fund industry, that this fund, this category which deliver close to 8 to 9% over a 10, 15, 20 years, total asset under management is just 11,000 crore for the entire mutual fund industry.
Wow. Okay, just one final question, Vijay, and that is on whether the different points of time wherein maybe the FD rate was higher than the GSEC yield as well, have GSEC yields over a longer period tended to deliver. And part two of my question, Vijay, therefore, is that somebody who's, let's say somebody is convinced with this argument, should she or he invest into a gilt fund only with a slightly longer time horizon?
Gilt fund investment has to be done with a longer period time, and people need to inculcate the habit of doing SIP in gilt fund and invest regularly. Point number one. Point number two, we have seen very brief period where the FD interest rate was higher than gilt fund, but after some time either the gilt fund catches up, the yield catches up, or FD interest rate has fallen. But what is most important, what I told in the beginning of program to you, when you invest in FD in India, you are not participating in the debt market in India. And let me give a simple illustration. Suppose you are a borrower with a bank or any company. Suppose you took loan of 1 crore from one organization. And from the same organization, you put fixed deposit 10-year back. So on the borrowing, you are paying 10%. And on the FD, you are getting 8.25%. So you are net negative 1.75% because you are paying 10%, you're getting 8.25. Suppose nothing has changed, the gap between borrowing and lending remain 1.75%. But what dramatic thing has happened is a floating rate. So when the interest rate drops in India, it immediately get dropped on the fixed deposit, but interest rate drop doesn't happen immediately. When the interest rate rises, on your loan, interest rate rises immediately. On your FD, interest rate doesn't rise that immediately. So I have done my own experience, and I'm telling you the 1.75% gap doesn't remain there. It inches toward 2% to 2.25%. So I'll give a same illustration. You have taken 1 crore rupees loan from a bank. You are paying 10 lakh rupees at the rate of 10%. So you paid 1 crore rupees to the bank. Bank gave you 825 FD interest. So you got 82 lakh 50,000. So your net loss of 17 lakh 50,000. Now suppose nothing has changed, but things have changed. FD interest rate has come down and it fluctuated. So the gap of 17 lakh 25,000 has become 24 lakh against you. It means that interest rate in FD has fallen faster, and
Right.
on the loan it has rose much faster. So just keep that in mind. If you are a borrower in India and FD depositor, you have a double whammy, because on the loan side you paid market rate, but on fixed deposit side you don't get market rate. Viewers need to keep that thing in mind. And last point, which is very important, if you just invest in fixed deposit alone, then you are extending your retirement age from 60 years to 72 years. So lazy fixed deposit makes you work for 8 to 10 or more in your working life. Just keep that in mind.
I think even if viewers, just keep in mind, even if the math escaped you, the simple summation is that if you're indeed borrowing, let's say you have a car loan or you have a housing loan. A housing loan is maybe not as great an example, but maybe a car loan or some other loan. But you also keep money simultaneously in fixed deposits, which I'm guessing that's what you're trying to say, right?
Yes,
Then
yes,
that is a double whammy of sorts, because if the interest rates fall, then your FD rate will fall, but your loan rate won't. And if the interest rates rise, then your FD rate will not rise in the same proportion, as the rates of your car loan or some other loan or a personal loan will rise. So don't do that. I mean, Vijay, just one last, it's a personal finance question, but I'm still asking you. It's not the ages of this show, but since it's such an important thing, quick 30-second answer. Would you, as an advisor, say that if I have a fixed deposit of 10 lakh rupees and if I have a car loan, which is say 10 lakh rupees, it's better for me to break my fixed deposit and pay off the car loan?
Much better to do that, and it's still better to do is that you, instead of putting in fixed deposit, you put in a gilt fund. Because if the car loan, suppose you are a businessman, you can take income tax benefit of the interest you are paying. On the personal account on GSEC, you can get much more tax efficient return. So you can do that. But if you are really concerned about the volatility, then pay your loan first.
Okay, so on the personal finance side, viewers, don't do this mistake. But otherwise, if you lost a bit, please go back and hear this whole show again. I think what the message that we're trying to understand is whether investing in a gilt fund is a much better option than investing in a fixed deposit. So many of us have fixed deposit investments. You've got to take a hard look at that and try and look at the other options available, which are as safe. Maybe gilt funds could be that as well. Please do consult your financial advisor before you take any such step. But yeah, if you watch this show, then it should give you some ideas. Vijay, thank you so much for joining us today and taking us to this math. It was really informative.
Thank you very much, and festive greeting to all your viewers, and hope everybody stays safe.
Yep. To you too, Vijay. Thanks so much. And viewers, we'll of course see you next Wednesday, but happy Navratras in advance.